As a finance professional in a disrupted business landscape, what does it take to be in demand? What does it take to attract great paying international roles? If you're an ICAN member, it'll just take one exam. That's all it takes to complete the globally recognized CHIOMA professional qualification and the internationally respected CGMA designation. As a CHIOMA member and a CGMA designation holder, employers will look at you as a finance professional, constantly acquiring new skills to add value to the business. That's why they'll be willing to pay premium to hire and retain you. If you have 5 years of relevant experience and are an ICAN member, you can directly sit for the final exam of the CHIOMA Professional Qualification, the Strategic Case Study exam. Start studying the CHIOMA Professional Qualification. Prepare to make an impact.
Good evening, dear professional colleagues, students and friends of our great institute. Ladies and gentlemen, you're welcome to another episode of ICAN on AIR. Today, Tuesday, the 28th of March, 2023, and the 8th episode in the marvelous by the Institute of Chartered Accountants of Nigeria. I am your host, Olamide Balogun, FCA. On today's episode, we will be taking a close look at the topic, auditor's negligence. Auditor's negligence. And our guest for today is no other person than Mrs. CHIOMA Obaro FCA. A brief profile of CHIOMA Obaro. CHIOMA has a successful career history with PricewaterhouseCoopers, popularly known as PwC, spanning many years in Nigeria and in the United Kingdom. She's a fellow of the Institute of Chartered Accountants of Nigeria, ICAN. She has also passed, in one attempt, a diploma in International Financial Reporting Standards certification exam. She was the best graduating student from Banking and Finance Department in University of Nigeria with a CGPA of 4.42 and has an MBA in Finance from Manchester Business School, UK. She is a member of the ICAN Professional Practice Management Committee, PPMC. She has been engaged in audits, accounting, training, and compilation of financial statements for several companies cutting across various sectors of the economy, and has worked as a financial controller with one of our clients. She has attended many training courses in leadership management, financial services, auditing, team management, to name but a few. She is a financial service specialist and has worked extensively with financial institutions in Nigeria and United Kingdom. She has hands-on experience in International Financial Reporting Standards, the UK GAAP, reviewing regulatory returns, to name but a few. Pardon me. She also has experience in capital adequacy and financial returns, regulatory audits of banks based on Basel principles. Her roles includes development and evaluation of organization internal control framework, budget control, including budget preparation, challenge implementation, performance review, and reporting, just to name a few. She is a chartered accountant. She is a chartered accountant of repute. Ladies and gentlemen, believe me when I say it is said to be a wonderful time with our guests. Permit me right now to go on a quick commercial break. As we always tell you, this is the perfect avenue for you to bring your goods and services as we have a global reach. So as I go on this commercial break, I'll quickly pay some bills and I'll come back with the guest segments. Call a friend who is not connected to join in, and I'll be right back. Please stay tuned. And just like I promised you, my dear the audience, we are joined by CHIOMA Obaro FCA. CHIOMA, you're welcome to ICAN on Air.
Thank you so much, Olamide. How are you? How are you today?
Very well, thank you. Thank you
Nice
so
to
much for
see
being
you
our guest.
again.
Good to see you
I'm
too. And
delighted to be
one
here.
thing,
Thanks for having
so
me.
glad to have you. I'm eager, and I'm sure our audience are also eager to like really hear from you, because one of the limited resources we have on this show is the time. So I'll just dive straight into it by saying that auditors' negligence has become one of the most critical issues in audit world, and this phenomenon cannot be overemphasized. We are blessed to have someone of your clouds on this show today, and our global audience are itching to benefit from your wealth of knowledge. Let us start by asking you, please, could you run us through the concept of auditor's negligence?
Thanks, Olamide. I think I'll first start by putting this within a legal structure. So under CAMA of course is what regulates all businesses in Nigeria. Section 360 of CAMA requires that auditors must confirm whether a company they are auditing has kept proper accounting records and whether information from branches not visited by that company were obtained for the purpose of their audit. It goes further to require that auditors confirm that companies' statement of financial performance and their income statements are in agreement with the underlying accounting records and returns, within the company that they are auditing. So this means that the role of an auditor is a role that is defined by law. Now, if we step away from law and go to the practice itself in terms of what the account and the international standards of auditing requires, it's clear that auditors owe a duty of care to the people that rely on the financial statements that they are auditing. But when we say that, I wish to refer us to one of the legal cases that every business student study in school, and we even study that in ICAN classes, if you remember. The judgment in Lopes LJ in Kingston Cotton Mill. The judge held clearly that an auditor is not bound to be a detective or to approach his work with suspicion or foregone conclusion that something is wrong, but the auditor is meant to be a watchdog, not a bloodhound. And so he can assume that management is being honest and he can rely on the representation provided that he takes reasonable care in performing his work. And that brings us to the concept of that reasonable care. And that is where the debate around auditor negligence often rests. The case in English law of Caparo Industries PLC versus Dickman is one that I need to mention. There, the judge made it clear that even though the investor invested in the company because he relied on the clean report issued by the auditor to purchase more shares of the company, and eventually he succeeded in taking over the company, and only to find out that the company didn't have anything backing them, and the company went under shortly after, and so he took the auditors to court. The judge in that case averred that the auditors owe no duty of care to potential investors or the public at large, so far as they acted within their reasonable duty of care to the public, especially to the people that they contract with. And so there's always been this debate around to what extent do auditors owe a duty of care, not just to the shareholders, who are the people that own the company and who they are really reporting to, but to the investing public at large. And so that is where the discussion and the robust argument around auditor negligence always stems from. And in looking at auditor negligence, we focus on three areas, what we call a three-way liability test. We are looking at whether the auditor foresaw or could foresee the likelihood that a member of the public would rely on that audit report that they are issuing. That is the one of the liability test. The second one is whether the auditor is in close contact, so whether there's a proximity between the auditor and the person that is relying on the audit report, i.e., the way there's a relationship between the auditor and the shareholders. Could there be an assumption or a linkage to somebody else that the auditor perhaps should be in close proximity with in issuing the audit report? And the third one, just quickly, is what we call the fair, just, and reasonable assessment, i.e., did management fraudulently misrepresent the facts? Was the auditor aware of these issues at the point when their audit was done and when they issued their audit report and failed to include them, or to issue, or failed to disclose them, or to issue a qualified report? So this three-way liability test is always what the court and even the investing public would look at when they are trying to analyze whether auditor negligence has happened within an audit setting. Thanks,
Wow.
Olamide.
Thank you so much, Chioma. That was indeed, you took me back to my lecture days, and I'm sure our audience are also like really reveling in that nostalgia because you broke it down step by step. As a quick follow-up to that question, within the context of our topic of discuss today, we will also like to get more of that background check of you explaining further. Could you please provide insight into the concept of ordinary negligence and gross negligence?
Oh, thanks for that, Olamide. So, I had started by saying that negligence involves whether there's a lack of duty of care, reasonable duty of care by the auditor. Now, ordinary negligence is when the auditor fails to exercise due professional care or to adhere to professional standards like independence standards and conflict of interest standard. That is ordinary negligence, i.e., did the auditor fail to detect material misstatement, which he should have detected if he had done a more rigorous audit, but did he fail to detect it from an oversight, right? An oversight or a lack of judgment on his part, and not from deliberately trying to misstate the facts, or knowing something that is wrong but deliberately not stating it. And this is where gross negligence comes in. So the difference really is in the degree or the extent of negligence. So gross negligence in this case is then the absence, the complete absence of that duty of care, i.e., the auditors in this instance were aware that something was going wrong or should have been, as in, they had every likelihood of being aware that something was going wrong. They ignored that, perhaps, after maybe talking to the directors, to the management compelled them to sort of tone down on the issue and convinced them not to report it or not to qualify their account. And so the auditors were aware that there was something wrong or something going on that just didn't stack up, that just didn't make sense. It could be for criminal intent. It could actually be from, oh, I want to help management, and really nothing criminal in it. But you were aware that that something was being misstated. So it could be fraudulent, it could be error, but you were aware of it. So that means that you've opened yourself up to gross negligence. So when the auditor makes a statement on the existence, for instance, of a material fact, so there's a significant transaction, an expense that management made during the year. So you saw that fact, you saw that expense, you knew that for management to make this significant expense, they need to have gone to their board to obtain necessary board approvals because of the material nature of this expense. You went to management didn't, of course, get the board approval, but they convinced you not to worry about it, that please, they couldn't get this approval because of one or two things. Maybe they didn't, if they had gone for the approval, the board wouldn't have approved, and so they just want you to let it go. That means that you aided management in committing something fraudulent. So while in the auditor's mind, you're just trying to be a nice man, you're trying to help management, you have actually opened yourself to gross negligence because you've disclosed or you've signed off on a material fact without reasonable supporting evidence. And so, in summary, negligence, ordinary negligence, is the failure to exercise due care. Gross negligence is a reckless departure from the standard of due care. So there's a case again that I want to use to explain this. So in the case of Ultramarines Corporation versus Tuch in 1931 in New York, the court held that even that if it's just ordinary negligence, that it is insufficient as a liability to a third party. So typically the liability that an auditor has in line with the contract of engagement that you signed is a liability to the shareholders. But invariably, there is a further liability to third party, to the public, who maybe made investing decisions or took one or two steps as a result of relying on the fact that you certified this account as being clean. And so because of that, there is that thought that you are liable to these third parties. But in this case, the judge clearly stated that this liability can only be established where the plaintiff, in this case, can determine that the auditors exercised gross negligence. And so it is this gross negligence that makes auditors liable to third parties outside the privity of contract that the auditor has with the shareholders, which is which really, if that is all that has happened, it's difficult to prove that the auditors would be financially liable if it's just ordinary negligence, and auditors can prove that they performed with the normal duty of care. Thanks, Olami.
Chioma, you've been absolutely excellent. The way you've been breaking this down, believe me, I'm actually taking notes here, and I'm sure our team in the audience are also taking notes and getting the value for the time they're investing with ICAN on Air this day. And I'd like to welcome all our global audience who are joining us all the way in Nigeria and even across the world from US, Canada, Malaysia, everywhere, who are always taking out their time every Tuesday and Thursdays between the hours of 6 p.m. and 7 p.m. Nigerian time to join us and tap from this wealth of knowledge. I say thank you, and keep your questions coming in. I would be taking them as we go on in the show. Chioma, that being said, could you please run our global audience through the causes of negligence and some of the effects or of consequences of negligence in general? I know you've touched on it a bit, but could you please expatiate further? Thank you.
So in terms of causes of negligence, there's a lot of things that can cause it, right? The very first thing I would say is that the auditor has not been taking care in even onboarding the client. So typically, when you get a new client, right, just similar to the way when you walk into a bank and you want to open a bank account with that bank, there is a requirement by CBN that the bank must perform serious KYC, know your customer procedures. They would get your utility bill, they would get references, you would complete forms. There's a lot of check that they do to make sure that you are legit, that they are contracting with a real person. It is not different from getting a new contract for an audit within an audit firm. You must have very rigorous client acceptance procedures in place. This includes both KYC, anti-money laundering checks, even verification of the license that the entity is using to do the business that they are doing. Sometimes you can get a new client that tells you, oh yes, this is the business I'm doing. I've done this business for how many years? I want you to come and audit me. And when you tell them, okay, do you have say a banking license or an oil and gas license or a telecoms license? And they'll tell you no, that they are still in the process of getting it. That is already a clear sign that something is wrong, because ordinarily, without that license, you should not transact in a business that is related to that particular sector. So another thing again that could result in issues for auditors is when the auditor does not take care to understand the client's business. We call it understanding the entity. Usually, sometimes in the very first year, the auditors spend a lot of time understanding this business because it's the first time that they are taking on board the client. But you notice that in subsequent years, it's sort of sometimes they tend to roll forward this understanding. And that rigor is no longer there in continuously refreshing their understanding of that client's business. What does this mean? A client that might start up as a small company, if you take, for instance, a mortgage bank that could be giving small loans to people, could expand and start doing more complex transactions. They could enter into forwards, they could enter into hedging, they could enter into a lot of transactions that are more complex. Now, if you are not diligent enough to go back and recheck and get in-depth understanding of that client's business on an annual basis, you would end up not properly scoping the business risk and then translating that to audit risk, which informs the areas where you would focus on and pay more attention in doing your audit. There is also the third one I want to mention around your documentation. Typically, in cases where auditor negligence is established, before that is done, there is always an investigation where the auditor's working papers are taken and regulators peruse the papers, go through the work you've done, ask themselves, if you had been in this situation, would you have done more? What you've done, is that the best you could have done? You can only be able to convince these regulators where you have very robust and detailed audit working papers that capture in great detail the comfort that you derived in auditing all the significant financial statement line items within the company's books. And of course, I can't fail to mention that as an auditor, it behoves on you to exercise a high level of professional skepticism in performing your audits, and just making sure that you wear the auditor skeptical cap whenever you're doing an audit.
Absolutely, that is very, very key. That's professional skepticism cannot be overemphasized because we need to move with caution. We are not supposed to be, like rightly said in your build-up, we're not supposed to be bloodhounds. We are supposed to be watchdog And so we have to balance that appropriately. And just as a follow-up question, auditor's negligence could result in liabilities against both the firm and the individual auditor. Please, could you take us through the specifics of auditor's negligence actions that could trigger these liabilities?
I had talked about this, touched on some bits of it, but
Absolutely.
Usually for audit firms are partnerships, right? So that means that you as the partner that is in that audit firm and that you're signing off your name on an audit report, you're individually liable to whatever you're signing off, but the partners within that audit firm are also jointly liable as well. Because at the end of the day, it is even if you sign off in your name, it is still for the company that you're doing that work. And so as an individual, you need to take proper care that anywhere you put down your name on an audit report, you can hold your head high that you have done every work you're meant to do to certify that financial statement. And what are some of these things that you need to do? Usually we say within the audit parlance that third-party evidence is the best form of audit evidence that you can rely on to perform an audit. What does this mean? If you then come into an audit and you do not insist on obtaining all your bank confirmations, you rely on the balances, on the bank balances that the company is carrying in their books, without obtaining bank confirmations that you send out independently. So you must first of all send out that confirmation independently. The response must come directly to you and not through the company. And then you will be able to confirm those responses to the balances being carried in the company's books. Once you don't do that, you expose yourself to negligence, because at every transaction that has led to fraud or material misstatement would have an impact on bank. And so even being diligent enough to make sure that you follow the proper secularization procedures and insist on getting all your responses before you conclude the audit already helps you sort of navigate one aspect of what could expose you to auditor negligence. Another thing that could expose you as well is when you don't properly scope the business and audit risks that could affect the company and in extension affect the audit. So in performing the audit, it's not the same rigor that I would give to complex transactions that I give to simple transactions. What do I mean? At the commencement of an audit, it stands to reason that you would first of all try to understand how those that manage that audit go about with managing the books, with controls around the books, and with making sure that things are done the proper way. Once you've gotten that understanding, it's then easy for you to scope what is significant for the purpose of your audit. Now, on those significant balances that you've scoped, you must then exercise due care to ensure that you test all material balances, material transactions that occurred within that significant balance during the year. The other non-significant balances, I'm not saying you don't do anything on them, but a high-level analytical procedure could help you just get comfortable at a high level with what management has done. That way, you're sure that there is no risk, because what is the risk to an audit? The risk is that there could be a material misstatement that means that the accounts on which you opined on is materially misstated. So what we try to do is to reduce this risk to zero as much as possible. And you do this by making sure that all the material transactions, all the material balances are scoped in and properly tested during the audit.
Okay, wow, perfectly put. And I like the way you paint it out there, that we need to ensure we do our own proper due diligence and ensure that we don't misstate things in the process of carrying out the audit. So, I'm sure our audience will be wondering that, being that auditors are also human, and humans are prone to errors, which can result in devastating consequences for the auditor. How can an auditor protect themselves from possible liabilities from audit engagements?
That's a very good question. There are several ways. Aside from just being diligent in your client onboarding phase, also making sure that the engagement acceptance procedure, i.e. the engagement itself that you are accepting to do, that engagement is one for which you have the requisite qualification and the right level of staff of skill within your firm to deliver on that engagement. The other things you could do just from a legal perspective is to ensure that in the engagement contract, you include a limitation of liability paragraph in your engagement contract. What do I mean? Like you said, auditors are human and these mistakes could happen to anyone, right? There could be something that you just didn't see, not from a willful intention or a willful need to mislead or obstruct the financial the users from seeing the true picture of the financial statement, but it's just from an oversight. So human errors can happen. So including a limitation of liability means that you're limiting the extent of liability that anyone can hold you to. Anybody that is relying on that financial statement cannot hold you to any liability that is higher than what you have limited. So for instance, if your audit fee, for sake of argument, is 5 million naira, your limitation of liability could be to limit your liability on that engagement to 5 million naira, which means should peradventure anything happen, the financial liability from that negligence cannot be more than 5 million naira. That is what limitation of liability does for you when it's well, when you put that in the contract and you discuss with the client and the two sides agree to it. There's also professional indemnity insurance. All firms should have this. It just protects, it's an insurance for professionals, and it just helps indemnify in case anything happens. So that way the firm does not need to shut down. I mean, if you look at the type of financial penalties that audit firms have suffered in the past, some have gone as high as $300 million. It's a lot of money. There's not a lot of firms that can pay out that huge sum and still survive and still remain a going concern. And so that in professional indemnity insurance becomes very key in ensuring that you have insurance to cover you should in case anything go wrong. There's also the letter of representation, which we would always insist that management gives to us. This letter of representation just captures different aspects of the financial statement and management needs to confirm or to represent to us that they have given us everything that is necessary for us to perform an audit and be able to issue a true and fair opinion on that audit. And of course, the last one is that for anything to happen, really, the plaintiff needs to prove that the auditor did not act in good faith. So once you as the auditor can act in good faith, comply with the minimum requirements of GAAP and GAS and all that, you then limit the auditor negligence that could arise from that.
Oh, wow. Brilliant. Absolutely brilliant, Chioma. You are on a roll. And believe me, our audience are really, really taking all this in. And I'm sure that putting up plans to put their firms and their partnership in proper perspective. And I'm talking about my audience. The questions are trickling in right now. And one of our regulars, Fabola Adeni, has one for you. He's saying, is it every financial malfeasance or dishonest conduct that happens in a client business that auditors are liable for, if not discovered and qualified in the audit reports? You've touched on that before, but you might probably want to shed more light on this.
Yeah, no, I'll just talk very briefly on it, and thanks for that, Mr. Fabola. So it's not every issue, every misconduct that auditors are liable for. I mean, there are 4 things that you need to prove in law before you can prove that the auditor has been negligent. Number 1, you must it's easy to establish a duty of care to shareholders because the contract of engagement that you sign is between really you and the company, which is owned by the shareholders. So there's already privity of contract between you and the shareholders. But when we talk auditor negligence, we're actually talking of third parties. We're talking of people, potential investors that want to invest in the company. And because they see that this account is audited by one of the big accounting firms, one of the big audit firms, they are sort of fortified to go ahead and invest in that company. So you must establish that the auditor owes the person a duty of care. Note what I said around establishing duty of care, the 3 liabilities that you need to prove in establishing duty of care. The second thing is that the auditor has to have breached that duty of care. So the way the auditor breaches the duty of care is when you can establish that there is something that the auditor in their normal course of duty ought to have seen and picked up, which they failed to do. So you must establish that the auditor has breached the duty of care. The third one is that there needs to also be an established fact that the plaintiff have suffered damages, financial damages, as a result of, that's the 4th one now. This financial damages was suffered because the plaintiff relied on the auditor's report, and it was caused because there was a breach of that duty of care. So it's not just easy to say that because something went wrong in the company, the auditors are liable. No. If the auditors had done their work, and they had done their work based, in the reasonable way that an auditor is meant to do that work, you cannot establish that the auditor has been negligent. For instance, in days past, before the banks were consolidated and all that, in days past, some of the then banks used to have 2 trial balances. When you come, there's one trial balance auditor, there's another trial balance that management keep in their pocket. So in that case, I mean, if you've done your work based on the trial balance that you've been given, with all the support document that management has given you to support that trial balance, it's then difficult for somebody to come and say, but you should have known that management was being criminal. I mean, you can only know what you're given by management or what in your normal course of duty you would have seen as part of your work.
That was very detailed, Chioma. That was really very detailed. But I mean, the world is changing, and the business environment has evolved dramatically in recent years with the digital revolution, which was well aided by the COVID-19 pandemic. I mean, this itching to be educated on the amount of risk this digital incursion into the business environment place on audit practice, and now such risk could result in auditors' negligence. Like, what would you say to that? What we've been going through right now?
So to the extent that IT controls, right? IT digital controls can be bypassed by hackers, by rogue employees who connive with the hackers. There is a serious threat to accounting and internal controls. And once the internal control of an organization breaks down, the auditors are at a higher risk of not issuing the right opinion, because the controls are actually meant to ensure that the company is doing things in the right way. Once those controls break down, because they've been bypassed by hackers, it layers an additional risk on the auditors to perform and to deliver their work. Imagine a company that has done business for 12 whole months. You as an auditor come in for one month or 6 weeks to 2 months, and you're expected to understand everything the company has done for the past 12 months. The only way that can happen is where you can rely on the internal controls put in place by management. So once this heightened digital risk causes a breakdown in those internal controls, it results in increased risk for the auditors to do their work in the right way. And so in doing an audit, even as auditors, we consider cybersecurity risk as a factor, as a risk that is available in every entity that rely on automated system, automated controls, automated processes. Cybersecurity risk has to be considered. And the focus then is on one, what is the governance process around that cybersecurity? What is the steering or reporting process within the organization for cybersecurity risk? Is there a committee on cybersecurity that deals with issues around the cybersecurity of the company? What are the processes that are in place to respond to cybersecurity threats in case they happen? And then what are the technical areas that management has focused on? In fact, when the auditor themselves do not have the requisite experience to audit this IT risk or this cybersecurity risk, they need to get a cybersecurity expert that can come and review in its entirety the cybersecurity structure of the company and be able to issue them a report that says this company that relies a lot on digital, there's enough cybersecurity control, and so you can go ahead and continue with the rest of your audit. So as soon as we do that, it's easy to then note whether there are breaches because the cybersecurity expert would have escalated it, or note whether there are alternatives that you can rely on, even where that cybersecurity risk fails. And just to add on a last note on this IT risk, sometimes the auditors tend to focus on the IT systems and database that support the financial reports, i.e. the ones that help generate the financial balances that we report on in the financial statements. Cybersecurity risk is a lot wider than this, because this financial report is a microcosm of the entire cybersecurity of an organization. And so when you're looking at cybersecurity risk, you must approach it in its entirety as an organization, not just on the aspect that impacts the financial statement line items that you're reporting on.
Wow, Chioma. Before I come to Taha Matthew's question, I'll just as a follow-up, since now we're not talking about cybersecurity and the effect, which you experience over the years in the audit environment, and having gone through the impact of technology disruption in the audit space, what effort would you rather want to see in place to achieve a foolproof cybersecurity system, if such is achievable?
So the first thing is to make it very relevant. Sometimes you see a bank do a strategy session, and it amazes me when cybersecurity is not front and center of that strategy session. And these are companies that rely heavily on IT system. And so the first thing I would say is you must determine the relevance of cybersecurity risk for the organization and set up a committee, a board committee at that. So the highest level board cybersecurity committee, whose duty is to oversee the cybersecurity structures, infrastructure, people, process, controls within the organization. You then need to look at the existing cyber defense controls in the organization. Are they operating effectively? First of all, are they even designed effectively? Are they properly designed in order to capture the risk for which you have set up that cyber defense control? After you've checked that, you then need to test whether they are operating the way you want them to operate. And usually, companies make the mistake of having internal staff do this test for them. I mean, there's what we say, that when you're reviewing a financial statement, you're too close to the financial statement you're reviewing. And so you need to step back, which means give that to somebody that is not close to the financial statement to review it. Same with cybersecurity operating effectiveness. Call in an external third-party vendor to come and test your cybersecurity, to come and try to penetrate the controls you have in place within the organization and check whether there are possible breaches within the company's IT environment.
Wow, Chioma, thank you so much for that detailed explanation. And to our global audience, we've been having as our guest today, CHIOMA Obaro FCA, who has been discussing auditor's negligence. And I dare say this has indeed been an eye-opening discussion, and we've all been learning the new things we need to do, or what we've been doing before but we've not been doing properly, how we need to align this properly. Chioma, the evolution of ESG has brought a dramatic turnaround to financial reporting. It is even feared that a comprehensive financial statement of a typical large corporation may require an involvement of several professionals aside the accountants. What effect has this change brought into the audits of the modern corporation?
That's a very good question, Olamide. I mean, environmental, social, and governance, ESG, the importance continues to intensify as businesses become increasingly, they are called upon to disclose their ESG performance, their ESG strategies. I mean, reliable ESG reporting hinge on the quality of information supplied by management. But there is then the expectation that as the auditor, you should certify or you should report on this ESG reporting that management has put in place. And so the auditor's rigor in auditing that information vis-a-vis what actually exists in the company is what then makes the difference between the public taking what management has done to the bank and saying that, yes, this management has done so well or has not done so well in their ESG reporting. These days, you open a lot of financial statements, you see a lot of ESG disclosures. The ESG disclosures are not covered by the auditor's report because they are part of the order information. And so there needs to be a concerted effort to have a specific auditor's report on ESG reporting by corporations. It would, of course, invariably increase the duty of care that auditors owe to stakeholders. But there are benefits to be had if this is done the right way. And what do I mean? If I take environment, for instance, if a company reports that the company has gone into energy efficient fixtures, for instance, the bulbs are now energy efficient and all that, my expectation when I look at the financial statement of that company is to see a reduction in their cost, right? I should see a reduction in the cost with respect to power, with respect to diesel usage. Perhaps the company has reported that the way power is managed, there's now a time when power is turned off. Everybody is told to go home. That should dovetail into a reduction in cost and then an increase in profitability. And so replacing those bulbs to energy efficient bulbs, implementing policies that regulate usage of power and water, for instance, in organizations, would lead to cost savings, which in turn will impact the bottom line. And, things like this is what stakeholders want to see. If an investor, for instance, wants to invest in two companies with similar share capital and similar profitability structure, what could make the difference in that investor's mind is how socially responsible one entity is versus the other. So if one entity discloses that they've constructed roads, they've given scholarship less privileged indigent children from low-income neighborhood, they've beautified the environment where they are doing business, and an auditor can actually go and validate these statements that the company has made, that automatically makes the worthiness, the investor worthiness of this other company higher than the other company that has not done anything.
Yeah, and so excellent.
ESG is very important in understanding how a company is doing outside the financial reporting structure of that organization.
Very well put, Chioma. Very well put. And to really come back to Taha Matthew's question, just briefly, he was just trying to know the relationship between auditor's liability and auditor's negligence. Like, probably there's a there's a relationship there. That's a question from Taha Matthew.
So thanks, Tisha. So one is an offshoot of the other. So there has to be an auditor's negligence for you to establish an auditor's liability. So when you've established that an auditor has been negligent, then it's then for the court to determine, or sometimes there's an out-of-court settlement where you then determine the liability that the auditor has with respect to that negligence establishment that you've done. So one is an offshoot of the other. So where you've established auditor's negligence, you would then go to the next step of determining what is the auditor's liability based on what the auditor has done or not done, as the case may be.
Okay, cool. And as a quick follow-up question too from Usman Sonny, he's saying if an auditor fails to keep hold of the working papers relevant for future audits, which now lead to an audit failure of the organization in subsequent year audits, can the auditor be held liable for negligence in that regard?
Thanks, Osman. There is actually a legal requirement to keep audit working papers for a minimum number of years. I believe it's 7 years.
Yes,
So auditor
correct.
working papers must be kept for that minimum number of years. So where you've audited, you can't destroy your working papers until you've met that minimum number of years. After that minimum number of years, the auditor has every defense if the working papers are not there, because after that minimum number of years have passed, you can't be held liable for not producing those working papers anymore.
Wow. Thank you so much. Like I said when we started off, time is always our limited resource on this show, and we just barely have like 5 more minutes to go. But as we custom, it is becoming increasingly difficult to ignore the relationship between accounting and legal profession because of the interrelated nature of their services. In what ways do you think both professional bodies could explore collaborative opportunities to the benefit of their members?
Thanks for that, Olamide. I mean, so a lawyer does not opine on the true and fair nature of a company's financial result. And to that extent, there's really not that much of a relationship between the accounting and the legal profession. But having said that, auditor's negligence in the context of today's discussion can have both a criminal and a civil liability attached to it. Criminal to the extent that there is actually a requirement under CAMA, under our laws, for auditors to do the right thing. So it could actually face criminal prosecution. Civil to the extent that you are either under contract, committed or tied to complying with certain minimum standards, or under the law of tort. And of course, under the law of tort, third parties can sue you. So those that you don't have contract with can sue you under law of tort. That's if they can establish that you breached your duty of care to them. And so to that extent, there could be that collaboration between an audit firm and a law firm to make sure that the auditors are doing the right thing, one, and two, are protected in case of what I would call, in some cases, frivolous suits that people raise, if anything happens with an organization. I mean, we must first step back and recognize that the duty of producing a financial statement that complies with the relevant standard lies with the directors and with management of a company. And so to the extent that they fail in that duty, they are first and foremost liable. But once you can establish that the auditors breached their duty of care, then the auditors too can be held liable. And to that extent, the legal and their accounting profession can work together to define ways around which auditors can work within a legal ambit of the law to protect them where they do not breach the duty of care to the third party.
Excellent, Chioma. Excellent. And as we custom on today's discourse, assuming some of the Nigerian political gladiators are watching you right now, which I'm sure they are, what would be your suggestions to them on policy implementation to further strengthen transparency and the audit duties within the public service space?
Thanks for that, Olamide. I mean, our regulators are already doing quite well in Nigeria, if I may say so myself. The Financial Reporting Council has brought about a lot of changes, that strengthen corporate governance within organizations. Also, regulators like the central bank, like NICOM, have also gone ahead to issue their own regulatory code of corporate governance that strengthen what the auditors do as well. Some of them include the minimum or the maximum number of years that audit firms themselves must audit an organization. It also goes further to include the maximum number of years that even the audit partner within that organization should stay before you rotate out that audit partner and bring another partner within the audit firm to continue until you rotate out as a firm. So such policies help to ensure that a fresh pair of eyes are looking at the accounts, and the auditor cannot be compromised in that manner. There's also the need to strengthen the audit committee and make sure that they are independent. Where the audit committee feel that they are remunerated or rewarded by management, they might not discharge their duty well, which is really to oversee the work done by the auditors. And so the audit committee must be independent and must challenge management and push back when an auditor notices an issue or raises a control gap, such that they hold management accountable to make sure that they comply with the recommendations made by the auditor in performing their audits.
Well, Chioma, you have been fantastic. And on behalf of our global audience, I would like to say a big thank you, but not before letting you conclude this way by saying that, I mean, we all know that ICAN is always open to ideas that would positively advance the growth of our members, the accounting profession, and the Nigerian business environment. Please, what is your advice or suggestion to ICAN on identifying and filling knowledge gaps to deepen and expand knowledge in matters relating to auditors' negligence? In just 2 minutes.
Thanks, Olamide. I would hope to do that in 2 minutes, because actually within ICAN, I'm part of the committee that review professional people that are coming for their professional practice license. And I see how rigorous that process is in making sure that only the best qualified are given that professional practice license, which is what entitles you to practice as an auditor really in Nigeria, because ICAN is still the first and foremost audit firm, accounting and audit firm in Nigeria. So what I would just encourage is that, one, there should be on a rotational basis selected files. So ICAN can perhaps start reviewing files of selected firms. The firms are already stratified into, say, the Big Four, the next 10, the second tier. So there should be an effort maybe to put together a committee, a quality review committee, who can look at the papers, the audit working papers of, even if it's one audit file, just look at it. Aside from suggesting areas of improvement for that firm, you could actually also take away areas that the firm is doing well that you can use to maybe include in the MCPE training programs and improve these other firms as well that might not be doing as well as the firm that you reviewed. So even the second one I can think about is, even for the new practitioners that are seeking practice license, usually they come and they do interview and they go. I'm wondering whether it's possible, if you say that you want to start signing opinion of companies, I need to review one work that you have done as a team member or as a manager. Let me see what you've done. Let me understand how you've done that audit. And then that helps you understand whether the person is even within the practice, or the person is just, some people do tend to hang around small firms and use their name to go and obtain ICAN practice license. So by doing this, you reduce incidences of that kind of thing happening. Also, include as part of MCPE training discussions around this auditor negligence and how auditors can prevent themselves from breaching their duty of care. And then ICAN should set clear standard that depicts minimum audit procedures that professionals should perform on financial statement line items, and communicate this regularly to practitioners, perhaps in the MCPE training, so that that reinforced knowledge would guide people in the course of their work.
Excellent.
Thanks, Olumide. I'll stop here.
CHIOMA Obaro FCA, thank you so much for giving us your time this day, Tuesday, as we discussed auditor's negligence. You have been fantastic. I, on behalf of myself and the entire membership of ICAN and all the millions of viewers, would like to say a big thank you to you. Thank you so much.
Thank you. Thanks for having me. I really enjoyed being here today. Thank you.
Thank you.
Thanks everyone
Thank you so
for
much.
a fantastic session. Thank you.
Thank you. And viewers, that's it for today. Like I always tell you, it's always a good time to be with us on ICAN on Air every Tuesdays and Thursdays between the hours of 6 p.m. and 7 p.m. Let me quickly rush through my announcements. As we all know, the fellowship conference is now coming up in May. So you have the whole of April to quickly get those application in and get them certified so you can be conferred with the title FCA, which is, it makes you the fellow of our great institute. Also, the ICAN annual awards and dinner, the tickets are selling fast, and all this information can actually be gotten on the ICAN website, that is www.ican-ngr.org. Please feel free to visit the ICAN website. And like I always remind you, the ICAN subscription is long overdue, so do the right thing. Pick up your phone, pick up your token, go on the internet and make that payment right now. Till I come your way again this week, Thursday, with another excellent guest and topic. Do stay safe and have an amazing evening. On behalf of the producers and the editorial team, I am Olamide Balogun FCA saying thank you for watching and bye for now.